Hey, everybody, welcome to Doc's Investing RX, with podcast where I prescribe financial freedom. I'm your host, Doc, and today we're going to deep into a strategy that Wall Street uses to get paid while they wait. It's called option selling. That's right, option selling, not buying like you're used to, maybe on a fancy Reddit gambling thread, but option selling. This strategy is powerful, profitable, and pretty chill if you know what you're doing. So let's dive right in. First off, what do I mean by option selling? So, in short, basically, instead of buying lottery tickets that you pray that they're going to hit, which is basically like being in a casino, you're selling these tickets, right? To people that give them the right to buy or sell a stock from you. And what do you get in return? You collect premium. Okay. This is cash money that you are getting paid. Now, you probably heard of calls and puts. Are just the types of options. But when you sell a call, you agree to sell your shares at a certain price. When you sell a put, you agree to buy the shares at a certain price. So either way, you're collecting cash up front. So again, guaranteed cash money. So think of it like this. It's like charging someone to hold a fishing pole in your pond. If they don't catch anything, you keep the cash. If they do, well, you still win because you agreed on the terms up front. So think about buying options is like buying lotto tickets, right? These scratch offs. You could win big for sure. But remember, most lotto tickets expire worthless. Option sellers, on the other hand, make money from time decay. It's the silent killer of option buyers, but in this case, it'd be your best friend. Studies show that 70 to 80% of options expire worthless. So that means sellers keep the premium. You're not betting on wild swings, you're betting on stability or just controlled movement. For example, let's sell a put on an awesome company, a big name company, something you're not worried about that's going bankrupt. Apple. Okay. So let's say you sell a put on Apple at $170. Okay. For sake of argument, today, Apple's about $210. So $170, you're selling a put outside the money. Okay. You're basically saying that if Apple drops $40, you will buy the stock 100 shares per contract, right? At a strike price of $170. You will get paid $2 a share, and that's times 100, so you're gonna get paid 200 bucks, okay? So, by the time things expire and Apple's above $170, when it's all said and done, you keep that 200 bucks. And say Apple does, for some reason, tank below $170, well, guess what? You still keep that $200, and you're getting Apple for a price that you were willing to buy it for, which is $170. So, it's a win-win. However, say you're selling a put and you don't have the cash money, well, that's when you can dig yourself a hole, start using up margin, maybe start forcing sale of your stocks, and you can run into trouble. So again, this is for people who have the cash on hand. Say you don't have that much cash on hand, you can always sell a put spread. So in this case, say you sell Apple at 170, but you buy an Apple put at 150. Okay, so that's a $20 spread. 20 times 100 is $2,000. So your max loss would be $2,000. However, since you got paid 2 bucks, per share, that's still $200 profit. And if for some reason the economy crashes and Apple crashes, your max loss would have been 2,000 bucks or 1,800 if you count the 200 up front. So let's talk about cash secure puts, okay? This is the king of passive income. This is when you have cash money set aside that you're able to buy these stocks. You pick a stock you already like. You set aside the cash to buy it at a discount and sell puts. If it doesn't drop, you keep the cash and you keep the premium. If it does, you buy the stock cheaper and you still keep the premium. This is how I think about it. It's like putting in a limit order, except you're paid to wait. Now, here's a mini case study. A very famous investor named Warren Buffett did this with Coca Cola. He decided to sell puts on Coca Cola for a price that he was willing to put. If I remember correctly, it was $30 at the time. So he was selling puts on Coke for $30 and he was collecting premium. And when Coke finally hit, he was able to buy Coca Cola for $30 and collected a bunch of premium while at it. And then now he was able to build up his portfolio for stock at a cheaper price. And on top of that, collected premium. So that's put selling. Let's talk about call selling. Now, this works well if you own the shares of a stock and you want to earn some extra premium. The way you do this is you sell upside calls. So, say you have 100 shares of NVIDIA, and NVIDIA currently is trading about $164. Say I want to sell a call for NVIDIA at $175, and I get paid $10 premium. Well, $10 times 100 shares per contract, that's $1,000. So I'm getting paid $1,000 if I'm willing to sell my NVIDIA at 175. Well, NVIDIA right now is 164. That's $11 upside. So that's another $1,100 for 100 shares, plus another $1,000 premium for willing to sell the stock at that price. That's $2,100. If NVIDIA falls below the 175 strike price, I keep that $1,000. So it's a win-win. I'm still long the stock. I still collect premium. However, the downside is if NVIDIA just rips, say it goes to $200, well, then I have to sell the stock at 175. Or you could do something called roll the stock. You basically buy back the call for a loss, but then you sell a call for a higher strike price in the hopes for capturing a little bit more premium for the dollar. Or the flip side is you could just sell a put at the price you sold it for. So if NVIDIA happens to rip to $200, you just sell the 175 put and you can get your shares back if it ever falls back under 175. Now, let's talk about the risk, the Greeks, and the golden rules. This isn't magic, okay? There's risk. If the stock tanks, you might be stuck with shares lower than your cost basis. If it explodes upward, you might miss out on big gains. But the key is controlled risk equals controlled reward. So let's just talk about the Greeks, okay? Just a little bit. There's a few things to know. Theta, all right? You've probably heard of theta gang. Now, this is time decay, and that's your best friend. Every day that passes, that's time decay, and that's a little bit of premium that comes off the table that goes into your pockets, all right? Delta, that's the likelihood of being in the money. So that's sort of your guidepost. Vega is the volatility. So the more volatility, higher premiums, but also more risk. So what are the golden rules? Well, only sell options on stocks you'd like to own, okay? Keep your cash ready. Don't go on margin. Use monthly or weekly expirations with high volume. Don't sell naked calls unless you love gambling. And again, naked calls are when you sell calls and you don't actually own the shares. Okay, so you want to know what some of my favorite setups? Here's a quick list. ETFs like SPY and QQQ, these are liquid, they're reliable. You could do dividend stocks like I mentioned Coca-Cola, Pfizer, PFE. Earnings season is juicy premiums, but again, higher risk. Earnings are a crapshoot and you don't know which way the stock's going to turn. And you can use tools like Option Strat, Bar Chart, the options profit calculator to analyze your trades. So look for trades with 70% probability of profit and at least a 1% return on capital per month. So if you think the stock market returns an average of about 7 to 10% a year, at 1%, you're looking at 12%. So you're going to outperform the market. Okay, fam. So that was a lot to cover. Just remember that option selling isn't just a strategy, it's a lifestyle. Okay. You're stacking small wins consistently and keeping it risk controlled. So again, you can always do those YOLO plays, but again, it's a risk. It's a lotto. It's a gamble, right? This is going to be a little bit of a different strategy. It's slow, it's steady, it's scalable. Those premiums is cash money. You can stack that cash and continue to grow your portfolio. Use that money to buy shares of your favorite stocks and continue to grow. So, what's your takeaway prescription for today? Be the house, be the landlord, be the calm in the storm. Okay. Start small, even just one cash secured put. You don't need to be a Wall Street wizard. You just need a plan, patience, and a little premium. So, this is Doc, and it's another dose of Doc's Investing RX. Don't forget to subscribe leave a review, and share this with someone who's tired of gambling and ready to start winning. Until next time, stay smart, stay steady, and stay wealthy. Take care.